Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. I wanted to go over today a latest development in the tax code. We just got wind of this a couple weeks ago, that it was proposed for retirees who were age 70 and a half, who otherwise have to take required minimum distributions from their IRAs, have a little bit of a tax break. The tax break that's been awarded now is actually called a longevity type plan for people in retirement, where you're able to reduce, in certain cases, if you're over age 70 and a half, your required minimum distributions by 25% up to $125,000 of an asset. So you can carve out up to $125,000 of IRAs, 401ks, or other retirement plans, or 25% of the total value of your IRAs, whichever is less. But if you carve out that percentage or lump sum, you're able to have special provisions on the required minimum distribution rule. Now, let me refresh your minds on what that required minimum distribution rule is. Many people in retirement, in fact, I got the question just today, why am I paying tax on money that I saved for my retirement? I had someone who wanted to take a portion of the money for personal reasons, and what happened was the IRS taxes, penalties, turn out to be anywhere from 20 to 28% or more of whatever they wanted to withdraw. So if they wanted $10,000, they had to withdraw almost $14,000 from the IRA to net after taxes the $10,000 that they really needed. They were very upset, and they said, why does anybody have these? And I said to the client, I can't tell you how many people in retirement ask me that same question. Why did anyone put me in these burdensome vehicles like 401ks, IRAs, 457 plans, 403bs, tax sheltered annuities, all of these different qualified plans, which in essence are a time bomb of shackles on your own money when you're ready to use it for the intended purpose, which was retirement. And here, lo and behold, it's a very expensive asset to try to be able to draw from. So they were very upset. They said, if I want $10,000 or I want $20,000, I may have to pull $25,000 or $28,000. I said yes, and they said, we're very upset at that. But I have a lot of younger investors and a lot of younger savers who are asking me, especially business owners, find any way possible to avoid taxes on my income. So that forces us to dump as much money as we can into these same qualified plans that are tax deductible and tax deferred, and all the growth is tax deferred, into those same time bomb vehicles that will later turn out to be a nemesis for them also. So we're all short-term investors, we're all short-term tax planners when we're saying, for you business owners especially, it's at the end of the year and your accountant says, hey, you need to go out and buy equipment, you need to go out and buy some tax-deductible expenses because we have to knock your income taxes down. Well, that's the problem sometimes in these IRAs. Well, now the government has come through with this new ruling, and the old ruling, which is the existing ruling right now, says everyone, once they attain the age of 70 and a half, has to begin withdrawing from your qualified plan or IRA beginning of the year following the year you turn 70 and a half. You have to take out a percentage, not all of the account, but a percentage equal to over your life expectancy, what would have drained the account entirely over your projected lifespan. Let's take an example. If I have someone age 70 and a half, depending male or female, the IRS tables might say your life expectancy is 23 years or 24 years. So in essence, in a simplistic form, that means you have to take out 1/23 or 1/24 of the account balance. And then next year, take out, you have 1 year less to live, so it might be 1/22. And it continues to grow the percentage. It's really earmarked by the IRS that you would be depleting your money over your life expectancy, and it would be finished. Now, that's not how it works, because you don't ever really deplete that asset just by taking the required minimum distribution. If you're taking required minimum distributions and don't need them, please remember, you don't have to spend them. All you have to do is take the required minimum distribution that's taxable, pay the tax, but that doesn't mean you can't go right back in, reinvest in an outside tax deductible or tax deferred account. So you can get into a non-qualified account and rebuild those assets back up to where they were before you paid the tax. So you can reinvest, plant the seeds, let that money continue to grow again if you don't need it in your retirement for a rainy day, or for long-term care expenses, or for any other unexpected expenses, or maybe a legacy to your children. You're building the assets back up that you don't need. So those are issues that you deal with when we deal with a 70.5 distribution. All right, let's take a quick break, and I'm going to come back and deal with some of this new law and how you can reduce the amount further that the government's saying you must withdraw, especially if you don't need it or are worried that you might outlive your funds and want to stretch them longer. Let's take a quick break, and we'll be right back.
If you're a business owner or an independent contractor, you know the cost of doing business. You have your equipment, your personnel, advertising costs, and doing everything you can to outdo the competition. But do you run your business, or does your business run you? Your business is truly an investment. Is that investment insured? Jack Driscoll is here to help. At Driscoll Insurance and Financial Services, he provides complete business planning services ranging from property insurance programs to disability, life, hospitalization, and long-term care programs. He not only designs insurance protection plans tailored for your business and protects what is already built, but strives to strengthen your business through providing employee benefit and group programs. It's through this unique combination of skills that Jack has become a valuable resource for business owners and managers. Educate yourself first by going to DriscollFinancial.com and clicking on Business Insurance, or give Jack a call at 412-833-1500. Your business and your employees need you to be prepared, and you need to be protected. Log on to DriscollFinancial.com or call 412-833-1500. Driscoll Insurance and Financial Services. Insure for today, invest for tomorrow.
Okay, let's dig into this issue. I have many clients, and I know many of you are looking at retirement with a number of fears and concerns and trepidation, and one of them is the fear of outliving your assets. But a different one there are a lot of people who do not ever need nor want to draw from their IRAs at all. And I use IRAs as a general capture of this whole law, because anyone who has assets in a 401k and is age 70 and a half, if they're still in the 401k, is subject to the same rules. Same thing with a 457 plan for your police officers, government employees. Same thing for the 403bs for hospital employees and some government workers and schools. So the school teachers, if you still have a 403b, all of these different types of qualified plans have a required minimum distribution rule that says once the participant turns age 70 and a half, if you've not been drawing from those IRAs, or even if you have, you must begin drawing at least up to a rate or a percentage that equals that asset will be depleted over your life expectancy. So if you're taking out 1% a year, which would be 1/100th, then that would be, if you're going to live 100 years, that asset theoretically would be depleted over 100 years. Well, think about it, folks. That's not necessarily true. If your life expectancy is 100 years, and you're taking out 1%, which is the correct percentage, and it's earning 3 or 4% interest. Because if you think about that, you realize if I'm drawing 1%, that account will not be necessarily depleted over 100 years. In fact, that account might be triple or quadruple the size 100 years later because it's earning 3 to 4 times the rate that you're withdrawing. So keep that in mind when you're planning for your retirement assets. If you're required to take the minimum distribution, and you recognize in your accounts that your assets are earning a higher rate than the required minimum distribution that says you should be depleting your assets over your life expectancy, then you are lengthening the life of that asset beyond your life expectancy. So do some planning here. What about those of you who don't want a required minimum distribution coming out of your IRA at all or other qualified assets? Well, there is some help. One of them is this new law. The new law is saying, as I mentioned before the break, you can, in most cases now, brand new law, take out or carve out the lesser of 25% of all your qualified assets or $125,000. But remember, it's whichever is lower. Once you carve those assets out, you're only allowed to reduce your required minimum distribution if you invest those assets into a longevity annuity. And the longevity annuity is prescribed by the government. It is qualifying longevity annuity contract, otherwise known as, or going to be known as, QLACs. And what's happening are these longevity annuities are fixed annuities. They are designed to not begin or not required to begin payments until a later age. So those percentage of the assets that you carve out and place in one of these qualified longevity annuity contracts is not required to pull money out of it. And in fact, you can defer taking any required minimum distributions maybe as long as 15 years from age 70 and waiting until age 80 or 85 before you're required to take any amount out. And what else is nice about that account, if you use it, is the amount that you're required to take out then at age 85 is only the then required minimum distribution based on your life expectancy beginning, let's say, age 85. So you've opened a new window of at least 25% of your retirement assets, or $125,000, again, whichever is less, to not having any required minimum distribution burden on those assets for maybe 15 years. Well, think of the benefit that provides. Some of you are on Social Security. All of us should be on Social Security by the time we are at 70 and a half. You know you pay a higher tax, or a higher portion of your Social Security is taxable based on your taxable income, your otherwise taxable income. So imagine the benefit when you say, we have less taxable income. So what would happen in this case might be, you might be reducing the amount of Social Security that's taxed from 85%. You may drop down to the threshold where only 50% of the Social Security is subject to tax. So you can begin to see there are some strategy and planning opportunities as a result of this new law. Now, what you're going to want to do is get to a qualified financial planner who can help you evaluate all of these different scenarios. I can help provide you with reports or guidance in your own individual circumstances if you'd like to call and get some more insight on how this law might affect you directly. When you have the tax planning strategies that are now apparent because of this law, you have an opportunity now. Maybe you were qualifying for PACE and then just got over that limit due to taxable income and thought there was nothing you could do about it. Now you're learning, wait a minute, there is a portion of your assets that are within your control on whether you're taking taxable distributions or not. So this is valuable information to be made aware of. What I'm finding this month is most people's advisors have not apprised them of this, so I thought I'd put it on the radio. And I thought I'd share it with most of the listeners and the viewers so that you can see benefits as they come about and not have to wait a year or two from now when or if your advisor, or maybe never, shares this type of information with you. I don't want you to miss out on golden opportunities and maybe fleeting opportunities. Maybe they're here today and not here tomorrow. So we want to take advantage of opportunities when they arise. So that's your qualified longevity annuity contract for all of you retirees who have retirement accounts. You should be meeting with financial advisors now, everyone with qualified accounts, sitting down with a financial advisor and saying, number one, why haven't you brought this to my attention? And number two, are there planning opportunities I should be taking advantage of that I'm about to miss out on, especially this tax year, that you want to take advantage of? All right, now, we'll take another quick break, so I'll let you catch your breath and get some pen and paper if you want to take notes. I'll get into some more details on how this law might be able to affect you and benefit your retirement plans. We'll be right back.
Most would agree that no one could put a monetary price tag on our lives. You and I are truly priceless. However, the cost to our loved ones could be dramatic if we don't prepare for the challenges they may face should we pass away. Driscoll Insurance and Financial Services has a great tool on their website, driscollfinancial.com. When you click on the link for a free life insurance quote, you can see the different opportunities available for term life insurance from several providers, including some well-known companies. All you do is answer a few questions about yourself. It literally takes seconds, and you may be surprised to see how affordable term life insurance can be. Experts recommend that you carry life insurance equal to 8 to 10 times your annual salary. So what are you waiting for? Go to driscollfinancial.com and get a free quote. And while you're there, check out the vast array of services that Jack Driscoll has to offer. Or call his office in Bethel Park at 412-833-1500. That's 412-833-1500. Driscoll Insurance and Financial Services. Insure for today. Invest for tomorrow.
Okay, welcome back. Now, there are a couple other features I wanted to share with you. Remember this unrequired minimum distributions. Some people do not want them. So we have IRA assets that a person in retirement says, I don't want to have to take from that. I don't like this at all. Well, this new law can help mitigate a little bit of that. But I'm going to share something else with you. When you do one of these annuities inside or outside a retirement plan, what a lot of people are choosing to do is try to structure an income in retirement that the person cannot outlive. So one of the greatest fears in retirement is outliving one's assets. One potential solution for that is through the annuity world, where you put a lump sum of money into a deferred or an immediate annuity. And in the case of the immediate annuity, you're requesting the insurance company begin making a monthly or systematic payment to you. It might be quarterly, might be annually, but a series of payments that you cannot outlive. And that's called annuitizing. Typically, that is referred to as an immediate annuity. And the way those plans work, you can have an immediate annuity that pays you over your life expectancy or until life or for a specific term. Now, it's important to this new tax law because if you purchase a fixed annuity and it's a paid for term, 10 years, 20 years, 15 years, that will not satisfy the new regulation. If it is an immediate annuity, and it is paid over your life, then it will qualify because it's paying over your life expectancy. Now, there's a risk here, folks, and I want to share, well, there are a lot of risks, but one of the risks are, where do you place your assets? You're placing those assets with a financial institution. Is that financial institution sound? Is it an institution you need to check the history of their payment ability, claims paying ability? You also want to try to figure out when you're making these choices of where to place those monies. When you take a life expectancy annuity, then what happens if it says they'll pay you over your whole lifetime and you get hit by a train next month? So where you were thinking, oh good, now I can't outlive my money, you ran into a situation where your money outlived you and the insurance company gets to keep it. We don't like those things to happen, and neither does the government. So this new law allows for a provision. Number one, when you're purchasing an annuity, and it's not a fixed term annuity, but it's a life annuity, you are in essence transferring the risk to the insurance company that you won't run out of money or the assets would underperform what you need, because they'll guarantee you a monthly check based on the credit of the company, etc. So take those guarantees very lightly. Nothing in life is truly guaranteed. Some people would say, or maybe not say, but I would think about, okay, instead of doing this $125,000 or 25% into one company, why not take 25% or $125,000, cut that into 5 pieces, buy 5 different longevity annuities with 5 different companies, each for 1/5 of the total amount that's allowed, and diversify the risk of a company going wrong. So there's just a thought I share with you there to help diversify that risk. But the longevity risk works like this. If you get hit by a train next month and you gave an insurance company $125,000 of your assets and you took a life annuity, and it did qualify with this tax law, that money's gone. Because the trade you make with an insurance company when you switch to a longevity annuity is you're not taking payments until you're 85. That's true. But once you start taking payments, it's usually over life. So once that happens, once you start taking payments, get hit by a train the next month, it was a life as long as you lived or as short as you lived annuity. And there you can see the problem. So fortunately, the government allows return of premium riders to be allowed to put on as a death benefit. And obviously, I suggest you do that. Taking advantage of this somewhat reduces the monthly draw or income that you will receive in return for a protection benefit if you die too soon. The remaining premiums that you put in, the amount of purchase premiums minus what you've begun to take, will be payable to a named beneficiary of your choice. So you've preserved the asset for your family if you die too soon, but the risk is on the company if you live too long. So there's a double-edged benefit there rather than a double-edged sword like we had a minute ago. Now, I want to share one other thing with you. Please do not forget, I've shared with this in other shows. There are other ways to pull money out of IRAs after you're 70 and a half, beat the requirement, or let's say meet the required minimum distribution provision, and still not have to pay tax on that distribution. And that is by directly allocating your required minimum distribution once you're over age 70 and a half to a designated charity of your choice. It has to be a 501c3 charity. It has to actually be approved, one of the approved charities, nonprofits in the IRS tax code. And it has to be an approved IRA that you're drawing from. So there are provisions on that. $100,000, you have limits, and you also have that you're over age 70 and a half. But if you direct what would otherwise be the amount for your required minimum distribution directly from the IRA to a designated charity, a qualifying charity, you then have satisfied your required minimum distribution. You have not incurred taxable income, which again helps that Social Security issue I brought up early in the show. And you've helped a charity by getting that direct contribution, as opposed to if you're donating to charities anyway, and then you're taking your required minimum distributions separately and paying tax on them. So why not merge those two great noble efforts that you have into one? Be very careful with that strategy. That is a strategy that comes and goes. We have to wait for IRS guidelines every year, sometimes till near the end of the year to see whether that will still be available, and this year is no exception. So pay close attention to see if that rule will still exist, and you may want to defer your RMDs until closer to the end of the year to make sure all of your options are still open for you. Okay, folks, again, I appreciate your tuning in. That's another edition of All Things Financial. We'll be back again next week.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.